Hello traders, let's discuss one more strategy for bearish market. Well, this strategy is going to be very simple. What is the name of this strategy? Well, this strategy name is naked call. What do I mean by naked call? How this strategy is going to work? What is the current market example? This all things we are going to discuss in this video. So naked call means selling out of the money call. Well, it is also refers to as a writing out of the money call. So selling is equal to writing. So whenever you hear the term that option writers, it means option sellers, and basically sellers sell the call or put which is out of the money because they don't want to involve in the risk. So there is an unlimited risk involved theoretically. That's why they sell out of the money. So investor writes sell call options on the open market without owning underlying security. The maximum gain is the premium that the option writers receive upfront. Whenever you sell any options, the premium multiplied by lot size, that much amount you are going to receive in your account. So whenever you sell options, you are going to receive some credit into your account. So that will be your profit in this case. And if you see what is the maximum loss, well, theoretically there is a maximum loss is unlimited. You can have unlimited losses, but it is theoretical value. You already know that if market is going up and you have made the positions on call side, which is of out of the money call selling, then you will be squaring of the positions because you know that market is continuously going up. There is no way that I am going to earn some profit from that positions. Now let's see this with some example, and first we'll be seeing what are the risk involved, how to calculate break even and all this thing. So if you see, our strategy is selling the call because our view about the market is bearish. Well, here our motive is unlimited income with unlimited risk. Well, this statement is very much silly because here I am saying earn limited profit with unlimited risk. Who would take that chance? Well, there are people who knows that Nifty or Bank Nifty will not move above that point, or that particular stock will not move above that point, then definitely they are going to sell that stock and they are going to make the positions on call side. And some people even do in other way as well. Some people, what they do, they own the particular assets. Suppose you are owning 300 shares of HDFC in equity. So you are having some positions in delivery. If market goes up, then definitely you are going to earn some profit from delivery. But if market goes down, then how much you are going to earn? Well, you are going to lose. So what you can do? Well, you can sell call options. So if market remain at that point, or else if it increases but it will not increase that much of that particular strike price, then you are going to receive the call premium as well. That's how it is being used. Here if you see, what is the break-even point? Well, break-even point is simple. It is strike price plus net premium received. Strike price where you have made the position. Well, risk is unlimited. I have already told you. Reward is whatever premium you have received when you made the position. Margin required. Definitely there will be margin required because you are selling options. Now let's see current example. Currently, Bank Nifty is trading at 30,402.2. And if my view about the market means Bank Nifty becomes that it is going to be bearish and it is going to go down, then what I can do? Well, I can either buy put or sell call. Well, what are the advantage of buying put and selling call? Well, there is a lot of advantage and disadvantage involved. So I'll not go into deep, but I'll give you a quick review. If I buy a put and Bank Nifty goes only a little bit down, then I'm going to lose the time value. Whatever value I'm going to have at the expiry, that will be of intrinsic value only. But here, whatever premium I have received while making the positions on call side, that I am going to have in my account. So that is the profit. But again, the flip side is when market will move up, then definitely I am going to have major losses on call side. So here we'll be selling out of the money call. So out of the money will be 30,500. And if you see here, we have received the premium of 308.4. So let's calculate break-even point. Break-even point is just if you add this strike price where you have made the positions to this premium received, then that will be your break-even point. What do I mean by break-even point? Break-even point means if Bank Nifty ends at 30,808.4 at the expiry, then I'll be in no loss and no profit. Now let's calculate how much credit we are going to receive in our account. So the lot size was 25. So if you multiply this 25 with the premium 308.4, then you will be getting the maximum profit. That will be 7,710. So that much amount you are going to receive in your account. Now let's see the payoff chart. Now let's see the payoff schedule. And we are also going to see it on our payoff graph as well. So if you see here, if you wanted to make this payoff graph, then it is very simple. You just have to know the basics of options. So here we have sold 30,500 call options. So we have received that much points into lot size, which is 7,710 rupees in our account. So if Nifty closes below this, then we are going to receive the same amount till the expiry. So that will be our profit. What if Bank Nifty moves up? In that case, how much profit or how much loss we are going to get? If Bank Nifty moves up instead of down, then we are definitely going to occur some losses. How do we calculate it? Well, it is very simple. What you have to do? Well, on the expiry, well, at any day, your premium will be intrinsic value plus time value. But on expiry, time value will become zero of in the money as well as out of the money. So then your intrinsic value will be your premium. So here we are writing intrinsic value only. So how we are writing intrinsic value? Well, here if you goes 100 points up, then you're going to have 100 point losses. What is intrinsic value? Intrinsic value is simple. It is the difference between underlying asset and strike price where you made the position. Why I am telling difference? Because it is always positive value. So if you subtract strike price minus underlying asset price and put the mode, so that you don't get negative value. So intrinsic value will always be positive. Here I am writing it in negative also, that is profit and loss only. So intrinsic value will be your profit or loss at the end of the expiry. If it goes 100 points up, this premium will be reduced to 100 points. If it goes further 100 points up, then this value is going to reduce further 100 points. That's how I am calculating net payoff from call. Now let's see it on the graph. If you see here on the graph, here on the x-axis I have put strike prices. On y-axis I have put profit in rupees. Now let's draw this profit and loss on our chart. So if you see here, if Bank Nifty expires below 30,500, then we are going to get 7,710 rupees profit in our account. If it goes above, then our profit will reduce further. So this will be our profit and loss payoff graph for naked call option. That's it guys for today's video. If you found this video helpful, then hit the like button and consider subscribing this channel.